Good morning, everyone. Thank you for joining us to this panel discussion. On behalf of all the panelists, welcome to this session. Overview of trading, what are the new trends and opportunities in 2023? My name is Omar. I'm the Asia Pacific head of the Trading and Structuring Client Services at Murex, a leading provider of derivatives trading and risk management technology. Today, I'm very glad to invite three seasoned industry leaders to share their views on how the current macroeconomic and geopolitical headwinds are reshaping derivatives trading across Asia. How is the demand for financial products evolving? What trends do they see around client servicing? How can trading desks manage risk in times of heightened volatility and liquidity stress? Or how are the financial institutions using technology to support trading activities in this challenging environment? These are the questions we'll attempt to answer together with our panelists. So with me today, Jackie Tai, the Group Head of Trading and Structuring at Treasury and Market Division at DBS, based in Singapore. Hi, Jackie.
Hi, thank you for the invites.
And Leo Tai, the Head of the FX Rates and Derivatives for Asia at ING. Welcome, Leo.
Hey, Omar. Thanks for having me here.
And Abdul Munim, the Global Head of Electronic and Quantitative FX and Metals Trading at HSBC. And he's based in Hong Kong.
Hi, everyone. Excited to be on the panel.
So let's start with an overview of the challenges faced in 2022. Now we start with Abdul. Abdul, could you walk us through the challenges, both macroeconomic and geopolitical, faced by the market in 2022, and how did they impact your trading activities?
Hi, everyone. Absolutely. I mean, there are probably too many things to pick on for 2023. We thought that COVID was tough, but I think 2022 really showed us how difficult the market became. It obviously started off with the Russia-Ukraine conflict in the end of February, and that really set off a chain of different events through the process. So one was obviously the geopolitical tension rise within that region, but I think also highlighted old tensions between China, Taiwan, to other areas where this transpired. The one immediate impact for us was, with the Russia Ukraine, was things around sanctions risk that became a big factor, and then it continued into views around inflation, around risk around EM currencies in particular. We saw that take off in things like Central Europe as well, but the tensions really didn't change there. I think over time, with a few other events that transpired, we saw things like the Japanese yen and the sterling going through some tumultuous period of volatility.
Thanks, Abdul. I'll be moving to Leo, and I would like to touch on the trading volumes and the liquidity. So Leo, how do you see these challenges impact the trading volumes and the liquidity in the market?
Hey, thanks, Omar. I mean, I suppose given the heightened, geopolitical tension, we've actually seen FX turnovers and volumes this year increase. So the business activities definitely picked up, as I suppose more hedging requirements. So we're seeing higher demand for hedging requirements in the back of higher, more volatile FX and higher dollar rates, for example. So more volume going through, but admittedly, bid-ask spreads have widened out. So I guess it's a balancing act between these two factors, where you got more client demand, more volumes going through, but at the same time, having to pay a wider bid-ask spread in the market. And I guess the wider bid-ask spread, if you look at the market microstructure, I think a lot of the markets that have seen electronification through the years, they're really being tested this year, and really how deep liquidity pools are into these trading platforms. And at the same time, the composition of traders, I mean, I would, you know, if I look at the sell side, on the sell side, a lot of the traders haven't seen, inflation and volatility heightened for such a prolonged period of time like we have this year. So I suppose a combination of those, and then you got more transaction demand as well, kind of leading into this situation right now where we have slightly wider bid-ask spreads and an increase in a pickup in trading volume in general.
So high volatility and liquidity stress. If you go back to the macroeconomic environment and the central bank policies, and I would like to turn to you, Jackie. Can you please share your thoughts on the central bank policies and their impacts on the investors' risk appetite? And here, I mean, we all just had fresh news from last night from the Fed with further hikes, and especially in a prolonged time window. What are your views?
As you said, this morning we had a 75 BP hike from US Federal Reserve, and we're seeing the rate reach 3.754% as of today. And this year rate hike probably the most aggressive rate hike from Federal Reserve in the last 30 years. Last time we had a 75 BP high was back in '94, and I think many of us were even not on the trading floor on the financial industry, right? And there's a very strong reason why we've seen this very aggressive rate high is all this money supply, all the QE consequences, and also the fiscal stimulus around the globe kind of brought where we are today when we face the inflation challenges. And of course, central bank will be very, very alert about what challenge lies ahead. They can't really let inflation get out of hand. Otherwise, the consequence is going to be very, very out of their reach. And then once everyone having a higher inflation expectation in coming 3-5 years, and it's very hard to pull back. And that will hurt the economy, hurts everyone's life eventually. So coming back to what can corporate wealth customer can do, right? We've seen a very busy hedging activity from the corporate world. One, on the asset liability side, we've seen a very busy paying fixed flow in Asian rates and also in dollar, try to lock in the near-term liabilities. And some of them will go beyond maybe 5 years to lock in their liability. And this part, I think we saw a very busy activity since March this year. One more thing is we saw very busy activities going on is all the FX hedging. We've seen the dollar move up almost like 15-25% across most Asian currencies, right? So for those import exporter, they really needed to hedge their FX exposure. Yeah.
Okay. Now, despite these challenges and the more conservative approach from investors, as you mentioned, Jackie, we have seen plenty of new product trends paving their way into the trading floors in 2022 and over the last couple of years. Abdul, could you please share with us what are the newish product trends you are offering or exploring at the moment in your plans for 2023?
Sure. So I think one key thing is that despite the challenges, the banks and the markets continue to innovate. I think a large part of that innovation or growth that we saw was around cryptos, digital assets taking off, and while this year has been seeing a bit of a dampening in enthusiasm for that growth, in particular, the asset kind of bubble of Bitcoin, Ethereum, etc. I think the technology behind it still has a fair amount of growth and enthusiasm from takers, and I think we're in that space, operating with that mindset. We can see that things like the central bank back digital currencies taking off, ECNY. There's obviously multiple nations that are looking at that. And those are not cryptos; those are just digital versions of fiat. But the actual technology behind it are identical. The other thing as well is for HSBC in particular, We are big investors in ESG. We have been for probably the last 10, 15 years. And we are, despite the challenges, we still feel very strongly in these markets, and we continue to invest and grow our products in that field. And actually, just recently, we harmonized that with a carbon trading team as well, to again play on the sort of climate challenges. I know that was covered in yesterday's session, but it very much is I think is a continued theme, and I think that's good to see that that despite all of these volatilities, long-term plans, especially ones that are committed, are maintained.
Maybe back to cryptos. Do you think that in 2023 we'll see further consolidation or, let's say, mainstream acceptance of cryptocurrencies?
I think so. I think obviously it's been brewing slowly, and take up has been slow, and obviously there are different regulations at bay, and especially the big institutions like ourselves. It's not immediately jumping on the bandwagon because there are many angles to the decision. But I think definitely there is and again, I'm not privy to discuss all the details, but we are watching from the wings, sort of to really see how we can engage this in the future, how we can bring into our, for example, my business, market making desk for currencies, to then offer these things in the future. So I think that trend will continue.
All right. Well, cryptos have certainly been the most popular digital asset over the last couple of years. But we see more and more traction on other digital assets, such as CBDCs. You mentioned a few examples, Abdul, and tokenized assets. We haven't talked about them yet. So maybe, Leo, what do you see as benefits of asset tokenization for banks and investors? And what is the current state of adoption on these products?
Yeah, I mean, I think the benefits of tokenized assets, it's fairly well flagged in terms of the efficiency and transparency that a ledger technology like a blockchain can provide. And if you think about tokenization and fractional ownership, theoretically that sort of fractional ownership will increase liquidity of certain illiquid assets. Now, whether that theory really holds or not, of course, we need to see this in action. I think there's a lot of things that are being done, especially here based in Singapore, for example. There's a lot of interest by the regulators to make sure that we develop an ecosystem where tokenization of assets is kind of regulated, semi-regulated in a decentralized manner. I mean, it sounds a bit contradictory, but I mean, a case in point is this Project Guardian by the MAS, and I think yesterday, Jackie, your bank, actually went live on the Project Guardian project, which is basically tokenization of, I think, yen and Sing over the Aave and Polygon platform in collaboration with MAS and another big bank. So, I mean, the benefits of tokenization is clear, and I think the industry is working towards seeing how traditional finance players like banks like ourselves can play a role in this decentralized finance role. And again, the Project Guardian has set some guidelines on what exactly a TradFi role is in this tokenized decentralized finance space. So very interesting space. I agree with Abdul. This is something that will be very interesting into next year. Never mind that it's a crypto winter. This year, it's winter everywhere anyway. Whatever asset class you look at, but it will be something to watch out for into next year. And I think Abdul also mentioned, just sidetracking a bit on the ESG part, that's another product development on the derivative space that we'll definitely see more activity on. For us in ING, we actually one of the first issuers of ESG linked derivatives back, I think 2-3 years back, and we do see more and more interest and demand into these sustainability linked derivative products, especially here in Asia.
Well, it's great to see there is still so much financial innovation going on. Now I would just want to go back to the challenging market environments. And another trend that we see is that the geopolitical surprises are bringing sudden spikes of volatility and liquidity stress, and sometimes the usual asset dynamic and the correlations suddenly break down in a spectacular way. Leo, how can traders manage their risks effectively in such a challenging environment?
Yeah, I mean, $1 million question, Omar. If I knew the answer to that, maybe I wouldn't be here. But I suppose it's really going back to the basics, in my opinion. And again, looking at the type of trading team that you have, the type of algo that you have. Of course, intuitively, high volatility environment probably means that the traders need to be able to manage their risk positions more efficiently. They will probably need to compensate for lower liquidity via slightly wider bid-ask spreads. And for the algos, again, there's probably a need to retrain some of the algos where they've been previously trained on very rangy markets. Now you're in a situation where markets seem to be, especially this year, is a very trending market with big with big levels of retracements and correction. So if you got those market making or pricing algos or even predictive algos, you might want to retrain them. And again, I did mention about what I see as the microstructure of on the sales side on trading here. The junior traders have never seen this kind of volatility. There's a need for them to quickly adapt to these types of trending, volatile, persistently volatile trading conditions.
Thanks, Leo. Let's stay on the same theme and see how technology can support trading flows to overcome the challenges linked to these high volatilities in the market. Jackie, at DBS, how are you leveraging technology to improve the way traders manage their risk?
DBS Group has embarked on the digitization journey over the last 10 years. We started from corporate banking, consumer banking, and now treasury markets. It has benefits us a lot, particularly during the COVID time, like early 2020, because COVID hits us across all the region, and we send traders, salespeople back home. We had to split into the team A, B, C, couple sites to make sure we can provide similar services to our customers. So the advanced technology we have at home or different sites help out a lot in terms of pricing our risk, replying back to the customer about the RFQ, and also running simulation on the dynamic position we're having across all the asset classes. And last 1 year, we've seen volatility related product like FX option, interest rate option, commodity option spike up a lot. So the very fast latest technology help us to run the simulation many times during the day. And that help us to navigate in a very volatile market. And we'll be able to monetize the intraday movement or even the daily movement.
And another important area where technology brings value is on process digitization and automation. And we have seen banks embarking in their digital journey far before we experience the current challenges. I mean, especially a bank like DBS, as you mentioned, Jackie. I would like to turn to Abdul and understand or get an answer from him on what do you think are the likely focus of automation and digitalization for 2023?
So I think technology is the core of our business. I mean, in my role in the quant trading business, it's this technology-led area. We are focused on really improving our current offerings. We are largely a electronic business, so I think we are probably have been operating in that way for many years. So the question is really enhancement. How can we get better? One example of that is we developed recently a chat function. So we have if you like, an AI bot that interacts with a human being. So it initially started off as a project within the bank to, so query certain aspects of, prices, to curves, to even things like, common lookups, etc. That usually takes a lot of time for the user to navigate many systems to get to the answer. You just chat. We're all familiar with chat. We all, most of us now prefer to chat than speak. So it seems like the natural sort of path of least resistance when it comes to interaction, whether it's with a system or a human being or a business. So beyond that, we've developed that into a function where our clients can interact and chat and ask for sort of similar things that they are obviously allowed to see, etc., and help. And the other thing is slightly more adventurous, asking to trade with this chat function. So in a means of almost negotiative to actual realizing the trade. So I think this is, again, technology is a beast. I think banks have invested a lot of money, and not just banks, but many institutions, and the cost is a major function of that. So one needs to understand what is exactly that we ought to, that they want to achieve, and to really focus on that cost, because it can really grow, and there are many sort of false projects and poor returns on these things if not managed. And we know, obviously, technology often it's too late to really realize your mistakes and turn back and get your money back. So this has actually been a very challenging for us. So cost has been a driving force of understanding how to best leverage technology.
Thanks, Abdul. Before we close, I would like to ask you, gentlemen, in just a few words, to share with us how are you preparing for success in 2023, and basically what are the guiding principles behind your plans for the next year. Maybe let's start with Leo.
Yeah, I would say looking into 2023, I would see that a few of the core themes out that we in ING are looking at in financial markets in general. Of course, technology, like what Abdul mentioned, how technology can continue to play, will continue to play a very important role, especially with regards to increasing efficiencies and removing intermediaries. So that's one core part of the business. We mentioned about sustainability as well. I think that will be another focus for us into 2023. I would say also counterparty risk. I think Jackie mentioned this as well a while ago. There are a lot of regulations, new developments around minimizing counterparty risk in the form of clearing, netting agreements, netting jurisdictions. So I would say those would be the three-ish key themes that I will kind of focus on into 2023.
Thanks, Leo. And what about you, Abdul?
Yeah, and I think actually one thing that Jackie mentioned earlier about retrain algos, sorry, Leo mentioned about retraining algos, etc. I think that's a key thing. I think the environment for 2023 is going to be different. It's going to be, I think, challenging. I think it's going to require a bit more of a push away from the status quo. We need to look at the market. We need to understand that rates will continue to rise, and there will be a disparity between these things. So for me, it's about really being ready for that marketplace where we probably need to change our views and really focus on the new space. The other, as I mentioned, just to reiterate, I think that crypto is something that will become more and more accepted, institutionalized, and I really think 2020 could be the year where we see that sort of a moment where we start sort of at least comparing like an NDF or something in that remark. And then for us is really again mentioned by a number of participants here, is about conduct. There will be an element of central banks and regulators to really look at this with a with a more come through, and I think we need to be up for that challenge. And I think it's actually somewhere technology can play. For example, we simulate a lot of our codes to meet conduct risks, not just revenue risk. Whether they are right for the clients, whether they're right for the market, whether they fail integrity tests within the market they operate. So again, this is I think is a both a challenge, but managing that is a form of success.
Thanks, Abdul. And finally, Jackie, can you share with us your plans?
As we are in the business of serving corporate wealth institutional clients across all the asset classes, right, in long run, and given the geopolitical risks we talk about today, plus very, very divergent central banks policy around the globe. On one hand, you have a very aggressive Federal Reserve, ECB, and some of these G10 central bank in hiking modes. And we haven't seen the finishing line yet. And back to Asia, some of the central bank may not face the inflationary pressure, but we are facing capital outflow, weakening of Asian currencies, and some of the country may be running into deficits, right? So these idiosyncratic risks are very important for us to navigate. So how do we serve our client, right? We need to provide a well-balanced product. Some of these product can be a bit more conservative with principal being protected, given a much higher risk-free rate now is almost 4.5%, 5%. So give them some sort of optionality to protect their downside. And we can do this product structuring across traditional FICC product, plus the new digital assets, or even the ESG products. So this on the product and service side. Coming back to the staff, the people on the trading floor, it's very important for them to understand how we see the market going forward. We need to be very disciplined and also nimble about managing our risks. And motivating them in the right way is very important too, given the huge swing in the market. And the volatility, P&L pressure, will create a bit of stress on the people in the trading floor.
Terrific. It seems like the current challenges will most probably persist into 2023, and the evolution of the macroeconomic and geopolitical environment will be key in determining the right trading strategies for next year. We heard also from Abdul that 2023 might see crypto shining and entering dealing rooms in a persistent way. Another key takeaway is that technology is now more than ever essential in supporting trading businesses by addressing the needs to reduce cost on one side, and more importantly, to provide the right infrastructure to improve the bank capabilities and better serve their clients to drive growth for next year. I would like to thank our panelists, Leo, Abdul, and Jackie, for sharing with us their comprehensive insights. Thank you very much, everyone, for listening to us. I hope you found the discussion as informative and enjoyable as I did. And on behalf of all of us, let me wish you an excellent day ahead at Asia Risk Congress. Goodbye.
Thank you.
Thank you.
Thank you all.